What's up, all my fellow hustlepreneurs? Welcome to episode 8 of the Hustlepreneur Life Podcast. This podcast, we have Mark, aka the Wealth Whale. That's his handle on IG. Mark is an index fund investor, so stock markets. This episode is going to be highly sought after as far as for you guys. I know you guys have been wanting to see some stock market stuff. I need to know some more about the stock market. I've been dabbling in it, but it's going to be good to get some more knowledge on it, especially with index funds and the different. There's so much that goes into the stock market as far as investing. There's options, there's day trading, long-term investing, short-term investing, index funds, growth stocks. So I mean, hopefully, and I know Mark is going to be able to deliver a great podcast today with the answers. So he's very knowledgeable. I've been following him for a while, so I'll leave his info. Make sure you like and subscribe if you like the video. Please share this. I know it's going to be really knowledgeable or a really good episode. So without further ado, let's go ahead and bring Mark right on. One. Hey, Mark. How's it going?
Hey, man. I'm doing well. How are you?
Good. No, I appreciate you being on. I kind of, again, did the intro, told them about you being an index fund investor and kind of into the stock market investor, and it's been a highly asked for. I mean, this is episode 8, so you're our first stock market investor. So hopefully, they can learn a lot from you. It's been that and real estate seem to be the two that get asked about. Again, like I said, the Hustlepreneur Life Podcast is all about kind of entrepreneurs, but people who have that hustle. So maybe they have a 9 to 5, maybe they have everyday life. So maybe they're not fully an entrepreneur, but they're a hustlepreneur. They're out there trying to find ways to build, income, passive income. They still can have their job, whatever it may be. And they might just be a entrepreneur that, also, again, wants to have multiple revenue streams. So I think it's going to be a good podcast and a good way for you to be able to kind of help these people out and help me out too. I'm starting to get into the stock market, but I'm no expert at all. So, I'm going to learn a lot from this as well. So I appreciate you coming on.
It's an honor and a privilege, man. Really, I'm excited. I'm thrilled to be on. I'm thrilled to be talking to your audience about something I'm really passionate about.
Yeah, and I think what's cool is, that's the power of like social media now. I came across you on Instagram. Great content you post on Instagram. I just started following you a few weeks back, and I knew right away. I think I saw you had done like another interview or podcast. So I'm like, okay, well he's down. He seems down to do this stuff. So let me reach out to him and see, if you'd be down. So again, thank you for that.
Yeah, I mean, the whole reason I started the Instagram page at the Wealth Whale was just to be able to expand my reach and help people learn the basics of investing and, kind of build generational long-term wealth.
Right. And I think that's what's cool, about being able to teach people is that, you get that accomplished feeling of, knowing that you're actually changing people's lives, with the advice you give. So I guess we'll
100%.
We'll kind of start out with, just give a brief background on kind of maybe how old you are, how you got started, and kind of your quick, journey to where you're at right now.
For sure. I'm 26. I'm an immigrant. I come from an immigrant family. My family moved to the States in 1997. And like a lot of immigrants, they struggled financially. My family was actually, food insecure at one point, which means, we didn't really know where our next meal was going to come from. My parents racked up a bunch of debt. And, I kind of like remember like a lot of times for dinner, what we had was just like bread and a piece of butter, and it looking back, it seems kind of crazy because, me and my family have come a long way, but like I said, my family struggled financially throughout my childhood. My parents actually declared bankruptcy in 2008. So these experiences really kind of shaped my mentality about money. I became really, really financially focused. And I wanted to learn everything I could about investing and personal finance. And then when I was 17 or 18, I started working in a restaurant as a busboy, just earning, pocket money and whatnot while I was going to school at the local community college. And, I had honestly started developing poor money habits myself. I wasn't saving a ton, and I was wasting my money on stupid stuff. Can we swear?
Yeah.
You can swear. Okay. Yeah. So I was spending my money on stupid shit, and like the restaurant employee lifestyle, you go to work, you make a bunch of cash, and then you go out with all your friends and spend
right.
it at the bar that's open till 2 a.m. So I was doing a bunch of that, and then the chef who was working at the restaurant at the time was like, "Yo, man, you need to get your financial shit together." Like, he saw that I was a young kid and I was making a bunch of pocket money, and he, showed me the way and told me, you need to make sure that some of that money, at least some of that money, is going into your future. So you're getting paid now, he said, but you're not going to be getting paid forever. Make sure some of this money goes towards some assets. So he kind of opened the door to me, and I kind of harkened back to my experiences as a kid where we didn't have much money, and the light bulb just kind of turned on for me, and it was off to the races from there. And I just started learning about all the different retirement accounts that you could have, the brokerage accounts, the tax benefits, the basics of compound interest and investing and index fund investing, how to kind of understand what's going on in the stock market. And then, and it's just building from there and maintenance from there once you get the basics down. And then, I work still in the restaurant industry. I'm a manager at a local restaurant here in the Detroit area, which, by the way, we're both Michiganders.
I was just about to say that. Yeah. Okay. I was going to ask you where you're from, but
you're from Lansing, right?
Yeah, I'm from Lansing, Michigan. Yeah.
Yeah. I live just outside of Detroit.
Okay.
I live in the Berkeley Oak Park area.
Okay, Oak Park. Yeah. No, that's cool. Yeah, I didn't realize that.
Yeah. So, now I'm doing that. And then last year I bought in 2019, I bought my first rental property. So I kind of jumped into real estate a little bit. Again, I didn't know too much, but, I started asking a bunch of questions, and it was a hustle at first to get that rental property, up and going and rented out and cash flowing. But, man, it's been a good investment for me thus far. And my goals are to continue to invest as much into index funds as possible.
Right.
I think I invest about 50 to 60% of my income every month.
Wow, yeah.
Into investing or saving. And so I want to keep accumulating rental properties and probably be on the path to early retirement somewhere in my mid to late 30s.
No, that's good. I mean, that's kind of my goal. I'm 28, so I kind of not so much. I mean, I'm thinking like as my 40s. Like basically, by the time I'm 40, I would like to have enough going for me where I could essentially retire from any job that's not something that I'm passionate about or something that I'm not,
100%.
Exactly. 100%. So I think those obviously in what I learned from like Grant Cardone and stuff is just the one thing I take away from him is just kind of like that 10x factor, what he talks about, where it's kind of like if you try to make things too like, I want to retire by the time I'm 60, you're probably going to retire by the time you're 60. Even if you say I want to retire by the time I'm 30, you're going to at least do it, even if you fall short. I mean, even if it's 40, 45, or even if you say 40 and you retire at 45, you put yourself that much farther ahead by thinking that, by putting that early goal. It definitely helps, it helps jumpstart you basically and get you thinking a lot earlier than maybe you would.
100%. 100%.
So, well, that kind of leads into my first question is who should invest basically, and who should invest?
Anybody that's looking to grow their wealth long-term should definitely invest. Anybody that's looking to build generational wealth should definitely invest. Anybody that's looking to give their kids a head start financially, they should definitely invest. Like I'm 26, I don't have kids.
Right.
But people think I'm weird, but I think about how much money I'm going to pass along to my kids as a 26-year-old.
Yeah.
I don't know, maybe it's an immigrant thing, but
I mean,
that anybody that wants to build long-term generational wealth, definitely invest.
Yeah, because I mean, I have a son now. I had him in 2019, so I mean, yeah, that's all I think about is that. You know, I cherish what my parents did for me as far as like taking care of me and stuff. And like I said, I mean, we weren't rich by no means, but like my parents had good money management and you know, just kind of taught me the value of a dollar and all that stuff. But they took care of me, so I want to do the same. I want to be able to do the same for my son and be able to, you know, put him in a good position. When should somebody start investing?
The answer to that is always the sooner the better. So a lot of people have a misconception of how the stock market works, and that they think they have to be able to time the market and come in at the right spot and exit at the right spot as well, which history has proven is damn near impossible.
Right.
Like even the pros can't get that right. It's just impossible to call when you got to sell and when you got to buy back in. So if you're investing for the long term, the earlier the better. It's always a good time to start, especially if you're using index funds, which is my favorite investment vehicle, versus, you know, risky bets like options or things like that, or even just direct stocks, individual stocks. If you're using index funds and you've got you've eliminated your debt, that's an important part of it. And also you've got some cash reserves, because part of the investing game is not just starting but staying in the game. So if you were to, you know, run into an emergency and you were to tap into your investment accounts, well, you're just stopping that compound growth for no reason. You know, whereas if you had your kind of financial profile in order and you had those emergency funds set, when you came across one, you can dip into those instead of you know, hampering your investments from growing, and using those cash reserves instead.
Yeah, I know most financial advisors that I've spoken to and stuff like that, it's normally 3 to 6 months. They always is normally the numbers that they say to have. So it's basically 3 to 6 months of your expenses saved up for an emergency fund, and then clear your debt. They always say that too, like, you know, make sure your credit card's clear. When I've seen financial advisors, it's credit card clear, 3 to 6 months of expenses saved up, and then you know, they pretty much pick a percentage of your you know, income, and, you know, like you said, commit consistency.
Roll with it.
It's not just one-time deal. You know, you do it now and then you just leave it. Like, you gotta, like you said, compound it, put it in there, let it grow. So
and don't interrupt it.
Yeah, and don't interrupt it, like you said. So explain a little bit, because some people might not know what index funds are. So I guess go through. I know there's you know, you can, like you said, there's option trading, there's day trading, there's index fund investing, growth stock investing. There's, you know, what people long term, short term. You know, so just I know this one might be a long answer, but if you can just kind of go down the list and explain a little bit about them all.
Yeah. So, what's the stock market? The stock market is well, what's a stock? A stock is just a portion or a share of an individual company. So when you buy a stock, it's not just some random, you know, blip on a screen that goes up and down in value. It represents a company, a business behind each and every stock. So of course, some stocks are good, some stocks are bad. It's kind of an investor's job to figure out which stocks are going to go up, obviously. And, you know, there's some profit making to be had if you can guess properly if stocks are going down at the right time, which is not something I really do. But you got to always remember that a stock is a business. So when you buy a stock, you're buying a business. You want to make sure you buy a good one. And like I said earlier, it's just key to be thinking long term. Because on a short term, the stock market is a very volatile place. There's a lot of emotions involved. Like a piece of news can come out about, you know, Apple thinking about making an Apple car, and the stock market, you know, goes crazy and buys up a whole bunch of Apple shares, and the stock price goes up. But at the same time, tomorrow, you know, they're going to be reporting their earnings in the next couple of days. Let's say their earnings are not that good or worse than people expected. Well, then what's going to happen is the stock's going to go down because people are going to be selling off their stocks, looking for something else to put their money in, or moving out of that position in fear that the stock is going to go down long term. So you got to kind of be able to tune out that short-term noise and think long-term. So what an index fund is, which is my favorite kind of investment vehicle, is basically just it's just an investment vehicle with a bunch of different stocks in it, like the S&P 500, which is an index that tracks basically the 500 leading and prominent companies in America. So what happens when you put your money into an index fund like the S&P 500, your money will get spread out amongst all those 500 different companies in different proportions. So if you think of it as kind of a pie chart, where each company represents a different size slice, so Apple, which has, each slice is based on their market value. So Apple is the most valuable company in the world, the market. So they represent the biggest slice of that pie. It's like 6.5% or something like that. And then followed by that, you have other big names. I think Microsoft is next on the list. They represent maybe 5.5%, something around there. Amazon, 4.5%, and so on. Facebook, all those other companies, all the way down to a lot of smaller companies at the end of the list, which represent, a really, really small portion. So when you put your money into that index fund, it's going to spread that money out based on those exact proportions. You put $100 in, $6.5 goes into Apple, 5.5 goes into Microsoft, et cetera, et cetera, et cetera. So the really great thing about index funds is that you get to be instantly diversified. So there's 13 sectors, for example, in the S&P 500. Those industries span from energy, tech, real estate, telecommunications, healthcare, all 13 major industries in the U.S. So you don't have to go, pick around and figure out what industry is going to be doing well in the future. You just get to kind of own them all. And then as, things tend to progress, over time, you'll see that, good companies obviously rise to the top and bad companies, can sink to the bottom. But the great thing about index funds is if those bad companies sink to the bottom and go to zero, they come off the list and new companies with greater potential come on. So what you have is these bad companies can only go down to zero, but the great companies can go up, endlessly, 100, 200, 500, 1,000%, because there's no ceiling. And so there's this tremendous upward bias, and it's one of the reasons that in general, over the long term, the stock market tends to rise. So this, for an investor, is a really, really great tool for passive investing, where you can kind of rest assured and sleep easy at night knowing that your money is hard at work without being too active with it. You don't have to, log on and, track the stock market every day or see which company is doing, what. You don't have to lose sleep at night worried if your, all Tesla portfolio is going to sink by 50% tomorrow, which it very well may, could, because when you are invested heavily in one company, your entire portfolio, your wealth is, really tied into the performance of just one company. When you buy an index fund, you get to spread it out and be a little more diverse. So to put it, is a quote I wanted to share from Jack Bogle is that, or he said that you don't have to look for the needle in the haystack. You just need to buy the haystack, which I think is a perfect analogy for what it's like to buy and own index funds.
Mm-hmm. Now, but I want to be a billionaire. I want to be I want to have bought Amazon when it was a penny. It was a penny, and I wanted to have put my life savings in when it was a penny, and now I'm a billionaire because it's worth 3,000. Like what's up with growth stocks? Explain a little bit about growth stocks and kind of, well, first of all, too, I guess the S&P 500 obviously pays a dividend, correct?
Yeah.
So
I'm glad you
explain a
brought
little
that
bit
up.
about the
Yeah.
dividend.
So the companies within that S&P 500 index fund that you own, they pay a dividend, which is essentially just a cash payout from the companies to the investors. It's a portion of the company's profits.
Mm-hmm.
And then quickly, I'll talk about this. This is another reason why the stock market tends to continue to rise over the long term, because we're going to always, as humans, we're always going to be innovating. We're always going to be coming out with new technology. We're always going to be growing. We're always going to be involved with business. And there's always going to be profit making behind the commerce and the things that we're going to be doing.
Mm-hmm.
And yeah, like I said, there's going to be short-term ups and downs, but over the long term, it's going to keep growing because as humans, we're going to keep pushing and innovating and creating new things. And there's going to be businesses behind all of that.
So basically, dividends are thinking like back in the old school days when you put money into a savings account at your bank, and you got to see that penny every. They added a penny to your account every month because you gained interest. So essentially, dividends are basically a better way to earn almost interest, I guess, because most people are used to savings accounts, or they do maybe have knowledge of like a savings account giving them interest. So essentially, I mean, that's almost what a dividend is,
Yeah, dividends are by far the best, most passive form of passive income. You don't even have to roll out of bed, and you can earn dividends from companies that employ thousands and thousands of people that are working hard to produce this money, these profits for the investors. There's a whole subset of investing or investors that focus primarily on dividend investing. So they
Mm-hmm.
go around and seek out companies that are in a good position financially to pay out really healthy dividends and grow their dividends over the long term as well. So like some dividend aristocrats, they're called, which are companies that have paid out sustainable, long-term, and growing dividends over the long term, like Coca-Cola.
Yeah.
Yep. They have, such a deep connection with the American society. Like they are everywhere. They don't just serve soda. They sell snacks. They sell water. They sell all sorts of different products. And they have a really, really strong competitive advantage. I mean, new companies can't just come in and be the next Coca-Cola, So Coca-Cola is going to continue to dominate over the long term, which is why Warren Buffett owns like 20% of it or something like that.
Mm-hmm.
Then there's companies like Johnson & Johnson that produce, essential goods for people, toothpaste and things like that, which if you think people are going to stop using toothpaste, then,
Right.
Don't invest in a company like that. But
Mm-hmm.
chances are people are going to continue to use toothpaste and lotions and shampoos and soaps and all these other things and diapers and whatnot that Johnson & Johnson makes and has a competitive advantage over others to make, that will keep driving their profits and dividends for investors.
So I guess the best way to kind of put the S&P 500 or index funds into almost like layman terms or whatever is kind of like, think of it as putting your money in a bank account, because people think, assume bank accounts are safe. So it's a safe spot, but instead of parking it into an account where you're going to make a penny or 0.001%, what is it against, like 12.5? Is that S&P? Is it long term? It's like
over the past like 100 plus years, the S&P 500 on an annual basis has given back about 10%.
Yeah, 10%. And again, from your bank
Mm-hmm.
account, you're probably going to get 0.001%. So it's just a better way to park your money for the long term. And I guess we should actually circle back to, how does somebody get started? Meaning, like, I know when I first started 3 years ago, I went to my bank. I went to PNC Bank, talked to somebody there, talked to a financial advisor. That's when he advised me, don't start investing. Yeah, he said, don't start investing yet, because he said, you got to clear your credit cards. You got to save up an emergency fund, stuff like that. So what did I do? I went home and I found out there was a thing called Robinhood. So I downloaded Robinhood.
Yep.
I still took his advice, but I'm like, I still
Yep.
want to learn. And the only way I can learn, like, I know I'm not ready to fully invest, but I'm like, I'm still going to buy a single, like a $5 share. I'm going to buy just something.
Just get your feet wet.
Just so I can watch it, just so I can see what it is and check it out. So explain where you can go to get started. Yeah, exactly. So explain a little bit where you can get started, how, and as far as like apps or going to your bank or not mortgage brokers, but stock brokers, just different things like that.
Yeah. Well, first, I would advise everybody to just first sit down and define your goals. Are you looking for a passive way to build long-term wealth, or are you looking to actively day trade for some side hustle income? Which is totally okay, but that comes with a little extra risk, and you got to be willing to do that. Like I said, there's lots of different styles and subsets and strategies to each of these kinds of things. You can invest in stocks, bonds, options. You can do value investing like we talked about. You can do the index funds. After you kind of define what it's all about, just go out and start using the free resources on the internet. Google the questions that you have, like how does the stock market work, or, et cetera, et cetera. Start seeking out answers to those looming questions that you still have, and don't procrastinate on that kind of thing, because you want to build momentum on this sort of thing. Look at resources like Investopedia. Get the Yahoo Finance app. That's an app I use for news and stock market tracking. Yep. Go to forums like Boggleheads, which is really into index funds. Okay. Look for free resources on YouTube as well, and just start learning the basics. And like I said, think of the questions that you have and just start searching for those things after you define what your goals are. From there, you can even get a more detailed approach into it by buying books on personal finance or investing. Some of my favorites are Rich Dad, Poor Dad. That is an absolute essential for anybody that's looking to invest or build wealth. Look at The Richest Man in Babylon. Lots of great lessons from that one. The Simple Path to Wealth by J.L. Collins. There's a book called The Little Book on Common Sense Investing. If you want to be even a more active investor, if you want to invest in individual stocks, look at a book called The Intelligent Investor by Benjamin Graham, who was Warren Buffett's mentor. Then start learning about the different account types that you need to have. What's the difference between a Roth IRA versus a traditional IRA? What are the tax implications for you? What makes most sense for you? Brokerage accounts, et cetera, et cetera. And then just pick a broker. Personally, I use Vanguard. As far as index fund investors, you're good to go with either Vanguard, Charles Schwab, or Fidelity. They're all good for index funds. If you want to take the more active approach, you can use Robinhood. I have a lot of friends. I'm not trying to knock Robinhood, but I don't use it.
I'm guilty. I use it.
Yeah. I heard a lot of kind of negative things about using Robinhood, but it does give you really good access, easy access, and a great user interface to, enter into the stock market. But, it doesn't offer those tax advantaged accounts like IRAs and things like that. So the Vanguard is a good place to go there.
That was my goal. That was my goal, is basically I start with Robinhood when I'm not investing a whole lot, kind of, again, get my feet wet while it's easy, like you said. And then, like you said, Vanguard is the one I've been having my eye on for when it's time to really go all in and really stay 100% consistent. Like you said, I mean, Robinhood to me, and you can maybe, like you said, back me on this, Robinhood is like that beginner kind of get you in, get your feet wet. I feel like it's good for that. And then, like you said, take a more of a I'm glad you named off a few of kind of the more solidified, more kind of main places to invest, because Robinhood is doing a great job of marketing and getting to us younger, people. They're doing a good job of marketing to us. So yeah, I mean that's the first thing we obviously get on. But like you said, it's good to know the advantages and disadvantages of all of them to make sure that you are investing on the right platform.
100%, 100%. Yeah. And then the last thing I wanted to add was just don't wait too long. The chances of your money going, if you're investing in index funds, the chances of your money going to zero are very, very slim. Just jump in, pick your investments, and keep funding them. The sooner you start, the better. The sooner you start, the more compound interest you can earn over the long term. So don't sit on the sidelines too long. Do your research, do your diligence, but it's important to just jump in and start investing as well.
Now, as far as growth stocks, explain a little bit about what those are, and like you said, kind of the pros and cons of growth stocks, or whatever you want to call them. But I know I call them growth stocks.
Yeah. So, like we talked about, there's value stocks and there's growth stocks. So, value stocks tend to pay a nicer dividend. It's when investors look for companies that have a lower share price, but represent a business that should be trading at a higher share price. So they kind of invest in that and expect it to go a little higher. Growth stocks are kind of more nascent companies where investors expect that these companies may not be profitable right now, but over the long term, they're going to blossom into bigger companies. Like Tesla, everybody's looking at Tesla as a major growth stock right now. Obviously, it's had a killer year, but up until mid 2019, it wasn't profitable at all. And even now, people argue if it's really profitable. So when you're investing in value stocks, you're investing in like really well-established businesses that may be trading at a discount for what they're really worth. When you're looking for growth stocks, you're investing in companies that are new, relatively new, and have a lot of runway ahead of them that haven't fully kind of developed quite yet. So there's a lot more risk in growth stocks, but there's a lot more upside. The great thing about index funds is that you can do both. You can get an index that has both younger growth stocks and value stocks, and you kind of get the best of both worlds. Vanguard offers a couple of those specifically.
Mm-hmm. And I also just want the viewers to know that we won't really be discussing day trading or options trading this episode. I mainly want to talk to Mark about index funds, growth stocks, just because, maybe a couple episodes from now I'll get like a day trader on and we'll talk. But just because I'm not personally into that right now, I think, I think it's risky. I think it's not worth it. I know, again, social media hypes a lot of things up and people claim, to be, showing pictures like how much money they're making. And I'm not knocking it because you probably can. It's just, I think there's enough stress in the world right now, and I don't need that type of stress or risk right now, so.
It's way riskier than I want to be involved in personally.
And I'm a big stats guy. So like, again, we have enough history to show us, where, there's enough history of this stuff. And over time, it's proven that, it's almost like gambling or doing scratch off tickets. Like you spend $1,000 and then you might hit, a $500 lottery ticket, but and it might have been a $10 lottery ticket, but in the long run, you're actually behind still because you've spent $1,000 in your lifetime. Yeah, you hit a $500 off of $10, but you're still $500 in the hole. So I feel like day trading is almost like that. You might have a great day or whatever, but the bad days are just end up, then the growth is maybe you are up, but to me, it's not worth the risk, in my opinion.
So in general, I recommend don't jump in and out of stocks. Pick good stocks and hold them for the long term. So, if you look at the study that was done by a company called Dalbar, which is a leading business research firm. So they illustrated that between 1995 and 2015, the S&P 500, like normal, returned about 10% a year. But they also found that the average individual investor only returned about 5% a year. So what they did was they cited that behavior was the reason behind that difference. So those that held on throughout the entire time, through all those ups and downs, there was a tech boom, there was a great recession. I mean, there was a pandemic, for God's sakes now. If you held throughout all that time, you would have got the maximum output of the entire market. But this study really highlighted the point that nobody can figure out when the market is hitting the top and when it's hitting the bottom. And you shouldn't ever try to be guessing, short term if it's going up and down. Long term, we basically kind of understand that it's going to be continuing to rise.
So I guess that brings us to a good part where it's like, again, I know you're an index fund investor, but when it comes to growth stocks, I assume you still have some. I mean, you diversify your portfolio and you have some growth stocks, or?
I have a few individual positions or individual companies that I've been holding on forever.
Okay.
These are the companies that I bought when I was like 18, just like you. Only Robinhood wasn't really as prominent back then. I bought them straight on Vanguard, but it was like my first way of. I honestly, it's blind luck. I've done really well on these companies, but I didn't really know what I was doing. You know what I'm saying? But I knew well enough to be, looking around, and Apple is one of those companies that I own.
But you again, obviously knew Apple enough, even without looking at balance sheets and looking at different things. I mean, you can just tell. I mean, when over half of the people you're in a room with are, have an Apple product on them, I think they're doing pretty good, so.
Exactly right. Exactly right. So, I try to keep it to 10% of my portfolio into that individual stocks. Right now, it's a little bit above that, because they've done really well over the last several months with this rally that we've been having. So I'm just making sure I'm not going to be buying any other individual stocks for a little while, and just funneling more money to rebalance my portfolio so that it's a little more heavily towards the index funds instead of those individual companies. Because I don't like having too much of my portfolio devoted to those few stocks. It's just, again, too much risk involved with that. I don't like to see my net worth bounce up and down like that too heavily.
What would we consider Apple? Because Apple does pay a small dividend, right?
It does, yeah.
So we would consider that, I guess. Obviously, if it pays a dividend, then it would be considered a dividend stock, even though it's a growth stock also. So I know we put terms on the name of, whether it's a company is, a growth stock or a dividend stock, but essentially you can have a dividend stock that's a growth stock also. And would you say those are safer, or is going after a growth stock, like you said, you need to plan ahead and pick how much money you want to, essentially you're okay with risking at taking a chance. Obviously it's not blind luck. Like you said, you should be looking or doing your research on the company, seeing, like you said, if it's a good company, if it's, if it's got cash flow, how much debt it has. I mean, there's a lot going into picking a growth stock. You don't just, you can, again, if you're willing to risk money, I guess you can just find somebody on YouTube that you, I guess, trust, or a financial advisor that you trust, and just whatever they tell you, whatever growth stock they tell you to invest in, you invest in. But if you are planning on doing it yourself, there's balance sheets. There's a lot that goes into looking at a stock and determining how much the stock value is going to go up. Is the company going to go up? Or like you said, the future. Obviously, we all know right now things are turning electric. So obviously what's hot right now, a lot of, electric-based things, and cars being companies. Obviously, electric-based companies, obviously cars being the first thing. But then you have, who's going to put all the charging stations? Now it's like, okay, what company is doing that? Are they publicly traded? And then,
the ancillary companies in that whole market.
Yeah, the people making the batteries, all that different stuff. Because I think it's Nvidia, or the one that does the chips.
The chip maker.
The chip maker.
Nvidia.
Yeah,
Yep.
they do the chips, for the Apple phones, and so it's not just, looking at the things you see every day on TV, but then again, it's all going to essentially be a risk. But what would you say to the people that obviously, I mean, there's stocks like Amazon, there's stocks like Tesla. Um, how do you get lucky? Because I know the person that sold their Amazon stock at like $100 is probably, and then never reinvested.
Killing themselves.
Or they were like, oh
Yeah.
man, it's 150. I'm gonna wait for it to go down. Oh, it's 250. All right, I'm gonna wait for it to go down. It's gonna go down. Oh, it's 450. I'm gonna wait for it to go down, and then,
Yep.
so
Yep. See, that's a prime example of timing, trying to time the market.
right.
So, if you come across a company that you believe in long term, that you have good confidence that it's going to continue to rise, you gotta maintain that long term mindset. That's why I stress that so much, because in the short term it can very well go up and down very significantly. And another way you can kind of mitigate that risk is to spread out your investment and just kind of dollar cost average into that investment. So you can pick a dollar amount and just, no matter what the stock is doing, just invest that every Friday or whatever when you get your paycheck. And then just, if it's up, you still buy. If it's down, that's a good thing because you treat that as an opportunity to buy those shares at a discount of what it was trading, especially if you're thinking long term that it's going to continue to rise. So you just keep entering into that position over the long term, and you can buy at lows, a little heavier, and then you can buy at highs at a more consistent level, and then just let it ride. But look, again, I'm an index fund investor. Like I did get lucky. I don't have a formula for getting lucky.
Right.
It kind of is what it is. If I would say, if you want to invest in individual companies with the idea of, the stock will blow up, like you probably shouldn't be entering into that mindset. But, like use money that you are not afraid to lose. Like if you pick that investment and you go for it, just pretend like you lost that money. If it's $500, if it's $1,000, whatever your unit is, just pretend you lost that money already,
right,
and just let it ride and just let it ride. Because I'm sure, like you see a lot of these Bitcoin millionaires nowadays, they held on for, well, those that did, because they believe in the product, and now they're sitting pretty nice.
So when do you sell though? Like I guess that's the churning question is, when do you take a profit? When do you, and I know, again, I mean, this might not be an easy question to answer, or, maybe a financial advisor would be needed, but when do you sell? When do you take the profits? When do you not,
So,
again, Amazon's 3,000, like it's 3,000 some a share, so when do you sell?
So Warren Buffett famously said that our favorite holding period is forever. Because even he does sell some investments, and there's no right formula for this kind of thing. For me, for my index funds, I plan on holding them forever. I plan on building them up so high that I'm living off of the dividends, or when I'm ready to be financially independent, I'll take out 4% every year and live comfortably off that. I don't know if you know about the 4% rule.
Explain that. Yeah, explain that to everybody.
So there's this thing called the Trinity study, where these three finance professors got together, and they basically wanted to see if there was a safe withdrawal rate from your investment portfolio. So they took 5 different kinds of portfolios, and they took as much historical market data as they could, and they kind of concluded that you can safely take out 4% of your investment portfolio every year, without running into the significant risk of running out of money. And they tested that over 15 years, over 20 years, and over 30 years. And then over a 30-year period, there's a 98% chance that you're not going to run out of money. So it's a pretty safe rule to live by. Now, granted, some people do contest this nowadays because this study was done, I think in like the late 90s or something like that. But it was updated in 2011. But now people are saying people are living longer, so you should make it the 3% rule. But it's just about being flexible. It's about your lifestyle choices. So if you take your annual expenses and multiply it by 25, then that's what you need to retire and live comfortably off of that 4% rule, where you can take 4% out plus minus, and feel safe that you're not going to run out of money.
Mm-hmm.
Yeah.
Now, so I guess that brings up a good point too about dividends. So you obviously always reinvest the dividends that you earn. Like I know with Robinhood now, they opened the feature because I have dividend stocks where it tells me when I'm gonna get paid out, but I have it set up to where it just buys right away. It compounds. It buys. So you obviously do the same thing. I assume have it reinvest your dividends.
Oh yeah. So like we said, dividends are those cash payouts from the company to those investors.
And when do they pay out?
Their portion of the profits. Well, some pay out every month. There's a great company called Realty Income that pays out a dividend every single month. That's another one of those dividend kings that has been paying consistently and higher dividends since like 1990 or something.
I'm not familiar with that one. You got the handle, or maybe I'll put that in the description.
The ticker is
yeah.
O. The ticker is O. Just O. Okay. That's a really popular company among dividend investors.
I love dividend stocks.
They own. So they're a REIT. They're a real estate investment trust, which is basically just another form of a company. And what they do is they buy and hold real estate, and then they rent it out to different tenants. So they own the land where there's a bunch of CVS's and Lifetime Fitness clubs and Home Depots and a lot of other like commercial real estate like that. And so every month, as that rental income is coming in, they pay out a good chunk of that to the shareholders. I think they are required to pay out 90% of taxable income to the shareholders. But again, regarding the dividends, so they're a portion of those profits. So dividends actually, they represent about 78% of the growth of the S&P 500 between 1970 and 2019. This is according to a study by Hartford Funds.
Okay.
So for perspective, if you invested $10,000 in 1970 and didn't reinvest your dividends, you'd end up with a $350,000 portfolio in 2019. But if you did reinvest your dividends, your portfolio would come out to about 1.6 million. So dividends are a really, really important part of your growth. Basically, as that money comes into your account, you put that money right back in to the stock or the index fund, and then that money earns more dividends, and it's just this compounding long-term cycle. So that they're a super important part of growth for your portfolio.
So I think that's the burning question right now is if I'm reinvesting my dividends, how am I paying my bills? I thought I was going to use the stock market to pay off my phone or to pay off my car, like how if I'm reinvesting everything and I'm putting money in, am I only doing it for retirement, or like how do I grab some stuff and make money off it while I'm going?
It's up to you. It's up to each individual investor. There's no right or wrong way. I know some good people that I've met online that don't reinvest any of their dividends, but their phone bill and their car payment are totally covered. You know what I mean? And then as they work at their W-2 job, they keep pumping more and more money into this. And I know one guy who's got his entire house payment covered. So that's a level of financial security that, he's going to enjoy for a long time, as long as those dividends keep getting paid out. But there's no right answer. There's really no right answer. If you want to start taking out your dividends and start, paying off some of your bills every month, you can do that. Go right ahead. Be my guest. There's nothing wrong with that. But if you're, comfortable with the cash flow that you have, let's say you have a really nice job and you're making a good income and, you know, you're able to save and invest every single month, you know, then and your priorities are more set towards growth, then yeah, focus on the growth and reinvest those dividends and invest long term. But if your focuses are more on trying to be financially independent through dividends as quickly as possible, then go for it, man. Pull those dividends whenever you want.
Mm-hmm. Yeah, I think that's a good thing to point out is that it kind of goes back to what we were saying as far as having a plan. You got to just have a plan. You got to, like you said, nothing's right or wrong as long as you're just, you know, you go, when you set your plan, it's almost like, again, if you're an entrepreneur and you want to start a business, you build a business plan. So you have a plan of action to what to do. Stock market's the same way because, like you said, that's why I love the stock market, is just because I love being I love the mindset of being an entrepreneur, being a CEO. And like you said, you're buying a piece of that company. So just a couple of things I did when I first started was I bought my car from a place called Carvana. And Carvana, you know, the customer service was amazing. I bought it online. The software that they used, I mean, it was a 3D software. I mean, it was the actual car. I could see inside, outside. They showed scratches. I mean, it was so...
I've always wondered about that.
It was so in-depth. It was amazing. The customer experience was the best thing I've ever experienced. Nothing like a dealership. We bought my wife's car a few years later from a dealership. And again, we got screwed over. We actually did. You know, it was a terrible experience. I had to call the Better Business Bureau. Like, it was bad. And
the dealership model is awful.
Yes.
I hate walking into a car dealership.
And I saw Carvana for what it was, and I'm like, man, this is and they became publicly traded. And I'm like, yo, this is the future. It's online. It's all online. They drove the car to my house. I mean, it was beautiful. And at the time when I got open Robinhood in 2017, I think the share ended up being like $13.50. I was only able to buy a couple, but like I wanted to get started and just kind of watch the company. I think right now it's gotten up to $250 this year. So in 3 years, you know,
hell yeah.
If I would have constantly done it, you know, I've only made, where am I at on it right now? I only have a few shares in it. So, I mean, my market value is only like $1,000, but I got like 4 shares in it. But yeah, it's
that's
like
$1,000 that you made pretty much totally passively.
Totally passively.
You didn't have to wake up and get out of bed and show up for that.
Right.
But that money still ended up growing and compounding for you.
Yeah.
And that's the beauty of the stock market that enough parents don't teach their kids about, about how important passive income is for you. And the stock market is a great generator of passive income and wealth.
Mm-hmm.
You saw that opportunity. You used this experience and you got ahead of it before everybody else caught on because you used it and you're like, damn, this was a great experience. I know other people are going to want to use this experience. And in turn, that's going to generate revenue and profit for the business. I want to own this company. Yeah. So that was very intuitive. That was smart of you. And, you know, you got rewarded for it.
Right. And that's the thing, too. Some people might go, well, if you loved it so much, how come you only have 4 shares? And again, that's because I'm not financially, or wasn't, especially at that time, financially ready to go all into the stock market. I'm learning, and I bought cannabis stocks too a couple years ago, and I lost big on those. And not big, I lost like 1,000, 2 stocks, and I lost like 1,000 on each, and ended up selling out, taking my losses, and just reinvested the money elsewhere. But I won on another one called Celsius. So Celsius is a lifestyle energy drink, and I work for a sports nutrition distributor, and we sold Celsius, and I saw it booming. I literally sold Celsius. I was contributing to the growth of the stock.
On that one.
Same thing. It was $3.50. It was in the $3 range for a couple years. This was just a couple years ago. Well, in the last year, they have 1,000% growth. They're at $64 a share. So again, luckily I did buy enough of those where around the fall time, I had enough profit in it where I'm like, I can pay off my car right now, you know? So I did, but it was $14 a share at that time.
Yeah.
If I would have, I didn't.
What's it at now?
64. Just imagine if I would have held on for 3 more months, you know, it was, I think it comes out to like another $4,000 I would have in there from the shares I sold. But this is like what you said. I'm not kicking myself because I was comfortable with my decision. Like some people will, oh man, you lost out on $4,000, but it was coronavirus. I wanted to get rid of my monthly car payment. I had the ability to take, and I didn't sell out all the shares. So when you take profits, basically, to explain to people, is you're not selling everything. Basically, if I'm up $1,700, I'm gonna sell $1,700 worth of shares to pay off my car. So I still have some in it. Right now, I have 51 shares, and it's $2,200 I'm up right now. So I'm still up, $2,200. So I have a 212% return on my investment right now.
Here's what I really love about that story is that you made a decision to want to cut out that car payment every month.
Mm-hmm.
So now, on the personal finance part of it, you now have that much more extra money every single month that you can look for new opportunities if you wanted, or use that money towards a long-term index fund portfolio, or maybe you see that next energy drink that you're distributing and you see it's going off because we know that those kind of things go in cycles. Maybe you find the next one like that. You missed out on, and again, like nobody can ever call the top or call the bottom.
Exactly.
But you did what was right for you at the time, and there's nothing wrong with that.
And I think one thing I can admit to, though, is because, and this is why it's good that I'm not all in right now. And when I do go all in, I will talk to more people and financial advisors and stuff because, again, you can lose a lot of money. So if I would have, I didn't think that, oh my God, the earnings reports are in a few weeks. They obviously blew the earnings reports, and right after they skyrocketed to like 30. I mean, they jumped like $20 a share in just a couple weeks after I sold.
That's crazy.
Because I didn't have the knowledge to think, or I didn't think twice that earning reports were 2 weeks away. I should just wait. I wasn't in that much of a rush to sell, but that's just things you learn. And again, when you're risking a lot of money, like you said, that's what comes with the risk of doing growth stocks is that timing or not knowing exactly. And I guess that's not really a risk. It's just the fact that if I was more in tune with it, I would have made more money. But I guess to go over what I have too. So I have some Coca-Cola, of course. I have Delta Airlines because we traveled a lot in the last 5 years and love Delta. Yeah. The experience with Delta. I don't drink soda. I don't drink any Coca-Cola products, but if one, it's a. But you know what? It's an obvious one to do.
I drink a bunch of. Have you ever heard of bubbly? It's the sparkling water. Yeah. This is the Pepsi version. This is called AHA or AHA. And me and my girlfriend, we started buying a bunch of these because we love just drinking these throughout the day because it's just real, and it's just water that's sparkling with flavors. But then you see them, and we were going to the grocery store during the pandemic, and these things were flying off the shelves. We never saw them restocked, and I was like, man, I'm glad I own some Pepsi and some Coca-Cola in my S&P 500 index. You know what I mean?
Right. Yeah, and that's cool. Again, like you said, I start to do that too. It's like, you start to pay attention to things a little bit more when you own some stock in it. I bought Microsoft recently just because, again, I like Windows. I'm a Windows user.
Love that company.
I'm not vegan, but I don't mind vegan stuff. So I did jump on the Beyond Meat bandwagon.
Dude, that's gonna play out. That's gonna play out for you, man.
And it's long term. It's long term. That's a long term one for me. At this point, these are all long term for me. I don't have anything that I'm looking to really cash out on at this point. Again, I just took the opportunity to pay off my car, but at this point, these are all long term holdings. I'll try to learn with Celsius whether. I'll start talking to people like, what do I do? Do I, if Pepsi buys them, what's going to happen? Because right now they're a privately owned company. Well, they're publicly traded, but my point being no big player has bought them out like a Pepsi or a Coke or anything like that. So, Yeah, like you said,
usually
it's
what
just
happens.
right.
That's usually what happens with one of those.
Mm-hmm.
And then what's going to happen is that stock's going to go skyrocket again.
Right. So it's like, at this point, it's all about buying. I would like to add some more stuff. I do have the Vanguard High Dividend Yield ETF.
Okay, cool.
I have that. I have the Dow Jones Select Dividend ETF. I have the S&P or SPDR S&P Dividend ETF.
Okay, cool.
And
The
then
spider from
yeah.
State Street. Yeah.
Yep. I just have Bank of America just because of I think those are I got when I invited people to Robinhood. I think I happened to get 2 Bank of America stocks, and
Sweet.
yeah,
That's a win.
yeah, I think and then with the dividends, I guess it's just gotten up to over 3, or maybe I got 3 or something. I don't know because I have 3 shares of it somehow, 3.06. So I don't recall actually with the Bank of America. But then I bought Alibaba just because of kind of that Chinese Amazon idea of it. I mean, looking at the growth. I know the China stuff recently has been. I bought this prior to pre-COVID. I've had my Alibaba pre-COVID, so I guess everything with China has happened. But
dude, the Chinese market is going to explode, and Alibaba is set for massive growth still. They're right in the middle of it. It's projected in the next 5 years, China's GDP is going to surpass the American GDP. And then it's projecting in the next 10 years that China's middle class is going to be about 500 million people, which is more than the entire population of the United States.
Right.
So that is a lot of buying and purchasing power, and that's a huge driver for economic growth.
What are some? I know you're not a financial advisor, and I know neither of us. I'm just saying what I have. I'm not advising anybody to buy anything. But what are some ETFs or index funds? I know you mentioned the S&P 500, but to kind of give people an idea of tickers if they already are investing. I mean, what are some to look at?
Yeah, so one of the major ones in my portfolio, besides the S&P 500, is VTSAX, which is Vanguard's Total Market Index Fund. As a matter of fact, it did better than the S&P 500 by a couple of points in 2020. So under this index fund, you own a portion of like 3,600 plus companies, basically just about every public company in the U.S.
What was the ticker on that one?
VTSAX. It's pretty popular in like the personal finance sphere.
So we're coming to a part right here where I'm on Robinhood and I'm looking it up, and I've noticed this with Robinhood too in the past. It's something that again, Robinhood is going to limit you on some of the stuff you can do.
Let me explain that. So you can so there are index funds and ETFs, right? They work a little bit differently, but they perform the same way if they're linked. So the ETF version is VTI.
Yep, I just saw that one.
You can look it up on VTI, and you're invested in the same thing. The only real difference that most investors need to be concerned about is this: with an index fund, after you meet their kind of purchase minimum or like minimum initial investment, which I think they're probably going to get rid of soon anyway, but once you reach their minimum, which is $3,000 right now, you can invest any dollar amount that you want. And that's what's really comfortable for me, that I can just throw $50 into the index fund if I want, or I can throw $500 because it's just a random dollar amount. For me, it just works better that way. With an ETF, VTI specifically, they own the same things and they perform the exact same way. They're intentionally linked like that. But the ETF version trades on the stock exchange like any normal stock would. You have to buy those in full shares. Well, I guess on Robinhood you can buy those in fractional shares. Correct, if you wanted. But through Vanguard, for example, and some other brokerages still, you you got to buy those in full shares, which is the reason I went with the index funds, because I wanted to be able to throw any random dollar amount at it that I wanted.
Mm-hmm. Yeah, I like my ETFs just, again, because of, like you said, the safety of it. I mean, that's my own personal stock market idea is I am looking, my parents, again, worked at General Motors, so they have pension plans. Well, I mean, pension plans are unheard of now, so, I don't want to have to work to make money in the future, so now, essentially, I'm going to try using the stock market and dividends, like you said, to pay me in retirement or pay for my expenses. And obviously, I think the ultimate goal financially for most people is by the time you get to retirement, you're hoping that you did a good job of paying off your house if you own a home, or paying off, cars and different things, so that you don't have as many. The goal is to have less expenses as you get older, because you should be paying off things, paying off your mortgage. But how do you plan? I know you said to times your expenses on how much you need, but again, how do you take that dividend out of your account when you get to retirement? Like, how do you pay yourself in retirement with that money?
Yeah, so Vanguard makes it really simple. You can just go on and elect for that money every time there's a dividend payment. You can just elect for that to be not to go back into the index fund, but instead go into a money market account, which is basically just like a bridge account. It's just like a checking account that's in your Vanguard account. And then from there, you can get it sent over to your bank or your checking account so that you can use on a day-to-day basis. But as far as like the 4% rule, like if you're asking about how to start taking money out, as far as that 4% in retirement, you don't have to take that entire 4% out in the entire year, for the entire year. You should take it out kind of the way you put it in, you know what I mean, where you're just kind of taking it out as your expenses need it, all while you maintain that extra cash reserve just in case. Because, what we've learned through history is that generally speaking, over the long term, most years the stock market is still rising. So you want to gain that appreciation, but you're retired, so you take a little money out every week or every month or whatever that you need for the rest of the month, and take it out as you need it in retirement.
And I think when it comes to dividend stocks, I mean, what is the goal in retirement when I have maybe 1.5 million or $1 million, or if you even have 300,000, in it? When do you cash it out? Do you put it in your will? I know, again, now we're talking a little bit more stuff that maybe, we shouldn't be advising, but like, do I pass away with $1 million in my stock account, or kind of what do you do with all that money?
Okay, so that's a really great question. And again, I want to point out that I'm not a financial advisor, and everybody's situation is going to be completely different. There's no cookie cutter experience for this kind of thing. So, but in retirement, okay, so there's two phases, right? There's wealth generation, where you're building up wealth up until retirement. And then there's wealth preservation, where you want to kind of protect your wealth that you've built up over the past 30, 40 years or whatever. And you want to protect it from the stock market potentially crashing or something like that. So, but again, it's up to every single person. So what you do is, once you've accumulated 25 times your annual expenses, what you want to do is move that away from riskier investments like stocks into something a little more safe like bonds, up to maybe like 30 or 40% depending on your risk tolerance, because the bond market is going to be much safer than the stock market. So when stocks fall, bonds retain their value. In fact, bonds usually go up when stocks fall, because when the economic outlook looks scary, investors take their money out of riskier stuff and pump it into safer stuff. So that's that preservation thing I was talking about. So you can find you can do a little mix of things. You can maintain some of your S&P 500 index funds so that it continues to grow, as you're still in retirement, and then you still have something meaningful to pass along to, your kids. You can find a fund like that high dividend yield fund that you picked out, and invest, a good chunk of your money into that so that your monthly income is still pretty high. And then you can take another last chunk and put it into a bond fund like VBTLX, that's going to protect your wealth. There's an ETF version of that I don't know off the top of my head, but that, if you have those three kind of things, one to keep the growth going, one to produce income for you on a regular basis, and one to protect your wealth as you're still, taking money out and retired, you're going to be in a pretty good spot because your monthly expenses are going to be covered based on your lifestyle. Your portfolio is going to keep growing because you have that S&P 500 growth index. And then you're also going to feel pretty safe and protected just in case something does happen because you've got those bonds in place that are protecting that overall portfolio. That's kind of what I would do.
And now this is all that we've been talking about is obviously self-investing. So basically this is kind of choosing a brokerage to use or whatever and investing your own money. I also have a 401k, that comes out of my paycheck. So kind of explain that, if you can, just briefly, as far as the difference between what we've been talking about and then the 401ks, IRAs, just the brief rundown on those.
For sure, yeah. So the government in the tax code created something called the 401k that allows people to take a portion of their paycheck and invest it before taxes are taken out. So the idea is, since the taxes didn't get taken out, it's called being tax deferred. That leaves you more money for growth in your investment account. But then what you do with that 401k, once you're ready to retire, is you pay taxes, hopefully at a lower rate because you're no longer working and you're no longer subject to high income tax. You've got a much lower income because you're just living off of your investment portfolio, and you're paying a much lower rate. So that can be really beneficial for a lot of people. The only downside to a 401k and IRAs, which I'll get into in a second, is you're kind of locking in your money for the long term. I know specifically with 401ks, you can't really touch that money until you're 59 and a half. There are certain stipulations, like if there's like an emergency, like in the pandemic, for example, the government issued new legislation that allowed people to access that money penalty-free. But you're not really, the idea is to incentivize people to invest for the long term and set themselves up for retirement. That's why they put in that rule where you can't really touch that money until you're 59 and a half. On the other side, they also came out with IRAs, which are individual retirement accounts, for those people that don't have access to a 401k through their employer. And there's two different types here. So there's a traditional IRA where basically it works very similar to the 401k. You put in money, and those are pre-tax dollars. So you don't pay taxes on that money quite yet. It works a little differently because since you're investing on your own with a traditional IRA, you actually that money doesn't go in necessarily tax-free right away. Instead, you get a tax credit when you do your taxes at the end of the year. But as long as you use that tax credit to invest back into that IRA, it should, grow really, really well. I hope I didn't confuse anybody there, but you let that thing grow for as long as you can. And again, that same 59 and a half year rule, you can't really access that money. And then once you start taking money out in retirement, that's when you pay taxes on it. Again, hopefully at a lower rate, because now you're not working and you're just living off of your income from your retirement portfolio. The last one I want to talk about is a Roth IRA. This is the one that I have. I don't have a 401k. My employer offers one, but they don't give you a match, so I don't take part. For me, for my investing goals and my investing needs, Roth IRA was the best goal, or was the best account for me. So with a Roth, it's a pretty sweet deal. You put in your after-tax money in right now, so I don't get any sort of tax credit today, but I put in my after-tax money into that account and let it grow over the long run. But the beauty of it is that when I'm retired and taking money out, all of the money comes out tax-free. Everything I've earned in interest, all the dividends I've made, all of the capital gains, all of that money comes out tax-free in this account, which is why I really was attracted to the Roth IRA. In addition to that, though, it offers a little extra flexibility with access to the money. You can access up to $10,000 of that money if you're buying your first home, which I don't recommend you doing, because again, you don't want to interrupt that compound growth. But you can also access any money that you put in at any time for any reason without penalty. So any of your contributions, so if you put in $6,000 this year, you can take up to $6,000 out anytime for any reason without penalty, which is kind of nice, because it gives you that extra little safety net just in case anything ever really goes wrong and you really need access to some extra capital. But yeah, this is a really, really great wealth generating tool that investors have at their disposal. And I think many people should take advantage of because of those tax benefits and because of that extra flexibility. It's a really great retirement account, and that's the one I choose. But then there's also brokerage accounts. So the reason you spill extra money into brokerage accounts is because all of these retirement accounts, they come with a cap as to how much you can invest. So with the IRAs, you can't invest more than $6,000 every single year. Now, $6,000 a year over the long term, that's going to grow really nicely over 30, 35, 40 years. But if you want to speed up your retirement, you're going to need to be investing a little more than that. There's three things that kind of determine how much money you're going to retire with. And that's the amount of money that you invest, the amount of time that you're invested for, and then lastly, the rate of return. So you don't really get to choose the rate of return. You just kind of got to flow with the market. Overall, you can expect 8 to 10% on a yearly basis. Again, over the long term, averaged out, not every single year. But yeah, you use those brokerage accounts to spill or, fund extra money. So if you're investing more, you don't need to be waiting as long to retire. The more you can get into the market, the shorter the time frame that you have to wait to retire, because you got more money working for you and compounding. And instead of 30 years or 40 years, you may be able to invest in retire in 15 or 20 years, depending on how much money you get into that brokerage account.
And just to connect the dots, brokerage accounts are...
Oh, I'm sorry. Yeah, so brokerage accounts are just individual investment accounts. So they don't come with any of those tax benefits that we talked about with those Roth IRAs. However, there's also no limit to how much you can invest into there or how much you can keep into there. You can put in as much as you want. The only downside is that you are subject to taxes when you start taking money out. You're subject to the capital gains if you've held those investments for 1 year or longer. But, and this is kind of one of those things that a lot of people don't know about, you can limit those you can pay zero on those taxes if your income for the year as a single filer is $40,000 or less. As a married filer, it'll be $80,000 or less, which is actually pretty easy to achieve. You can you can live, if you're retired and you don't have a W-2 income or something like that, and you're just living off your portfolio gains, you can easily live off $35,000 to $39,000 or whatever under 40K and pay zero on those capital gains, which is a pretty sweet deal if you ask me.
No, yeah, that definitely is. Now, I guess to kind of give a real life example of it, so I have my 401k. So I guess I'll have you give me a little advice on what to do. So I have my 401k, my employer matched. So I was putting in the max. I was actually putting a little bit more. I know some people, again, say only do in a 401k what they'll match, but I was committed to that account for the long term, and I felt like that was a good spot for me to put a little bit more in. So I put a little bit more than the max. Well, with COVID, they unfortunately don't match any longer. What do I do with it?
Hold on to that sucker for the long term. So
even though they don't match, even though I'm putting money into it without them matching?
Yeah, so you can continue to do that if you want. Again, like I can't advise on each individual's person financial profile, but for some people it can be really beneficial to continue to invest into a 401k because you get a tax credit. You will lower your taxable income because you invest in that. And then what that will do for you is you'll be able to create more income at the end of the year or on a monthly basis to spill that money into a Roth IRA or invest more, whichever direction you choose. Personally, I don't invest in a 401k because I don't get to choose what I invest my money in. A lot of times you won't have just a simple S&P 500 index fund. That's the reason I don't invest into a 401k. For you specifically, maybe like consult your accountant or a CPA to see if like that's something that
like rolling it over into a different account or trying to do something like that with it.
I think I've heard about people have rolled a 401k into a traditional IRA, which could be a good idea because then you bring all that money under your control, and then there won't be any tax implications for you either. But then from there, you can start putting it into investments and things that you want to do. It's a really hard thing to say. Like it could be really beneficial for you if you just keep it and continue to invest in it and take the tax credit, or roll it over, or stop investing in it completely and just focus your efforts on a new account. It really all depends.
Yeah, I think what I'm probably going to do is just lower the percentage, because I do have it decently high. So I think I am going to lower it a little bit. And then, like you said, take that same percentage, though. I'm not going to take it in my pocket. I'm just going to take that other percentage and put it into another investment account and use that, per paycheck to invest. So,
For anyone that sees this, though, if your company offers a match on a 401k, that should usually always be your first investment, because that's free money and you don't want to leave that on the table. Those are the best kind of returns that you'll get in the market. That's a guaranteed return, and there's, like I said, no reason you should leave that money on the table. Invest in your 401ks, especially if your employer offers a match. Get that match.
Yep. So to wrap up the podcast, I like to ask a few questions. So the one thing is having a 9-to-5. When's the last time you had one? I know you mentioned earlier that you still have an everyday job. So kind of just, again, briefly on that.
Yeah, I still work full time. I'm a manager at a restaurant. Life has been really different lately. We're working limited hours, but it's a really great company to work for. So that's my primary source of income, and I plan on working there for a good long while. I don't know exactly how long, but that'll probably be the last W-2 job I have before my investment returns start, paying for my expenses every month. I really like where I work right now. The landscape right now for restaurants is really crazy.
Right.
It's really uncertain. But I think things are getting back to normal. We're starting to see the light at the end of the tunnel. And like I said, it's a great company to be working for. So I see myself there for a little while longer.
Nice. Any side hustles or any other, I know you mentioned a rental property. Is there anything else source of income that you have?
Yeah. So I haven't been taking out any money from that rental property. Again, it's like reinvesting dividends, all that money is staying right into that account. And then the idea is to use that in addition with some more, active income from my W-2 job to purchase another investment property, hopefully this year. And I'll try to do one a year. That's kind of the goal. Those are my only two sources of income, is that the real estate and the W-2 job.
Mm-hmm. Nice. Another question for you. Resources, or I guess we'll go with influences. So just maybe a top 3 people. These are just individuals that influenced you to do what you're doing now with investing, or maybe were role models for you.
Well, I got to thank that one chef that really set me straight when I was like 18, and who kind of taught me the few basics, or like opened the door for me at least, or brought me to the door. That was really important for me. On social media, there's a guy called Miles Longstreth. Maybe I'll connect you guys on Instagram. Mm-hmm. He is a entrepreneur on steroids, man. He's a hustler. Nice. I love following him. He puts out great content. He's an index fund investor as well. Okay. And he's able to leverage the income from the side hustles and pump that all into an index fund portfolio, which is sweet. I think he built in 2020, he went from like $6,000 in his investment account to like over $100,000, because there was a lot of growth, but also he's been just funneling money into that early retirement account, which is pretty damn awesome to see. He's been a really great connection, so I'll connect you guys.
Nice, I appreciate
on Instagram. Yeah.
Mm-hmm.
There's another guy on Instagram who goes by the Wealth Dad. His name is Sean. He's a G. He's a really great voice on the investing and index fund kind of space. He's another guy that works. I think he works in tech or something like that. But he actually wrote a great book, and I read it on index fund investing. And he sells it on his Instagram account and on his Twitter and whatnot. And that's actually one of his side hustles. So he's a great voice, and a great voice to follow, and a great account to follow on Instagram.
Nice. And I guess that kind of bleeds into also the question of like resources. So you kind of use those people to learn more. And again, I think you mentioned earlier, probably some of your resources still are Google, or looking it up on YouTube and stuff like that. Or do you have a financial advisor or somebody that you kind of bounce questions off when you have some ideas or questions about things?
No, I mean, I talk to people in the space like on a non-official basis, but for the most part, I seek to find out the answers to the questions that I have through the internet. I don't have a financial advisor. I think for most people, honestly, the financial advisors aren't worth it. For a certain amount of people, the fee or whatever, the percentage fee that they charge can be worth it. Like if they're helping with, estate planning and more complicated things like that. But for the vast majority of people, I really don't think they need a financial planner. They can pretty much find out everything that they need to know online for free and save a bunch of money in fees without using a planner.
Well, Mark, I really appreciate you being on. I definitely think you dropped some really good knowledge for people. I learned a lot
Thank you.
too from here. I think again, my investing mind is kind of going down the path of the same. It sounds like of yours. Um, Again, I'll dabble in growth stocks when I come across a company that I really believe in, or I've experienced that company, and I feel like I really know that company. I'm gonna do that too. I know it's easy for us all to, what if we bought in on Amazon? What if we bought in on
Yeah,
the
always.
Teslas and stuff like that? Which again, I mean that
Hindsight is 2020.
it is. It's 2020, and again, I think again, if you know the company and you know, go ahead, like invest in those companies if you know the company and if you really feel strongly about it. Like you said, it's got to be money that you're okay with losing or okay,
Losing. Yep.
and you got to be okay with the stress of it going down because again,
Exactly.
most people, if again, like Warren Buffett always talks about, again, you're buying a piece of the company, so if the stock goes down and you trust that company, that company in the long run is going to do well, that's when you
That's an
buy.
opportunity to buy.
Exactly. You buy when others are fearful. And, you buy then. And again, you have to trust the company. Now, maybe again, things happen. But that's why, again, from what I've learned and what other people will learn as they self-teach also is the diversification, like that's why you diversify. Because if you literally only hold shares in two growth stocks, you're really betting on a lot, you know,
Yep.
and you don't have
Yep.
nothing to back it up. Again, I lost on cannabis. I thought that, these companies were going to be good companies. I did research, but I was still young to it or new to it. And yeah, I lost money on them. Luckily, again, I wasn't fully invested in the stock market, but I had other stocks that did extremely well that balanced it. So I really didn't lose.
Yep.
I didn't do the gain I could have did if I hit on all of them. But because I was diversified, I didn't actually lose money in the long run. They balanced out. So, but no, man. I really appreciate it. I think index fund investing is key to wealth at the end of the day. And again, I can't thank you enough for being on.
Yeah. Thank you for having me on, man. This was a lot of fun.
Yeah, you can plug yourself real quick. Again, your IG or any platform that you feel like you want to kind of plug in right here. Go ahead.
Yeah, man. I'm mostly just on Instagram at the Wealth Whale, and I do a little bit on Twitter with that same handle as well.
Anything big coming up, or are you just kind of looking to just keep, as far as social media goes, are you looking to start a YouTube channel, or are you looking to grow your IG? Are you going to start courses? I mean, what are anything
Yeah,
to look forward to?
I'm focused on building the Instagram account as much as possible, continuing to kind of broaden my reach.
Mm-hmm.
And then down the line, I do want to sell some sort of material that helps people helps give people the entire picture of, what they should be doing with their finances, etc.
Nice. Well, cool, man. Definitely. Again, I suggest everybody follow you. I follow you. I've liked all the content so far, and you. Again, the content you're putting out is, to me, it feels like value, and I know it's value. And I think other people will find value in it. So I definitely suggest they follow you, and I'm looking forward to whatever you come out with to see your growth. I'm excited now even more because you're a Michigan native, or I mean, you live in Michigan. I live in Florida now, so I left Michigan behind, but I got all my family there and all that stuff. So we still travel back. Well, before COVID, we travel back.
A little warmer in Florida right now.
Yeah, it's a little bit. Yeah, it's a little, and we're in South Florida too, so that helps.
Yeah,
especially with that heat. But again, Mark, thank you very much, man. I appreciate it. Have a good rest of your night, man.
You too, man. I appreciate it.
Thank you. All right, well, that was super exciting. Having Mark on was pretty awesome. I can tell me and him have pretty much the same mindset when it comes to investing, as far as with index funds, dividends. I'm always going to take advantage, though, of stocks, like I said, like Celsius, Carvana. I experienced the customer service from those brands. I've experienced their brand. So I could see, I was very confident in their success. I sell Celsius, so again, I saw the growth firsthand. Carvana, the experience was amazing. I've seen the growth. So, I'm going to continue to do that and invest in dividend stocks and stuff like that. But I hope you guys learned a lot from Mark. I know I did. I know you did. So again, check him out. I'm going to put all the links to his stuff, his IG and everything in the description. Again, as always, the episode was sponsored by Royal Legacy Clothing. That'll be linked in the bio as well. Like and subscribe. Please subscribe if you want to continue to see this stuff. We're going to continue to have more and more. Please give me input on who you want to see. We'll continue to go expand on the stock market stuff. Again, I'll get day traders. I'll get option traders. I'll get other stock market investors on here as well. I'll get real estate agents. We'll probably have Mark back on just because we did hit it off so well. And I think, he has more value to be able to share. I try to keep these podcasts, from an hour to hour and a half, just to keep it, not too long. So we can always have them on for a part 2. But yeah, like and subscribe, please. I appreciate you watching, all my fellow hustlepreneurs out there. So again, have a good night and tap into episode 9 next week. Again, this is going to be a weekly thing. So continue to stay tuned. And again, have a good night. Appreciate you guys.